Most beginners think trading is confusing because of charts, but charts are just a bunch of candlesticks on a screen. Charts are the easiest part about trading. Today I'm going to explain to you what can be perceived as confusing when it comes to trading. Today I'm going to break down tradable instruments in plain English, and I'm going to show you how they affect each other so that when you look at things like the S&P 500, NASDAQ, bonds, oil, gold, you're not going to just be nodding your head like you're understanding. You're actually going to start understanding today. So what is a tradable instrument? A tradable instrument is literally just a thing you can buy and sell in the financial market. If it has a price, if it goes up and down and people trade it, this is an instrument. Everything you have ever traded and will ever trade lives inside a few big categories. Think of the market like a grocery store. Different aisles, but the same checkout. So these big categories, let's think of them as big buckets. Main buckets are indexes, stocks, futures, commodities, bonds, currencies like Forex, crypto, and yes, even options. But let's not confuse you today. Now let's break down the ones you hear consistently. Number 1, indexes. An index is not a company. It's like a scoreboard that tracks a group of companies. And there are 3 big main indexes. The first one is the S&P 500. This index tracks 500 big US companies. Think Apple, Microsoft, Amazon, Google. The S&P 500 is like a snapshot of the health of big US businesses. The next one is the NASDAQ 100. The NASDAQ is more tech heavy. It's more volatile. It moves faster and more dramatic. It is basically like the market, but on espresso. Then we have the Dow Jones. It only tracks 30 US companies. It's slower, older, and more traditional. So those are the 3 main large categories. And these 3 main indexes are considered large cap. But there's a subcategory inside the index called small caps. And the first one is the Russell 2000. It tracks smaller companies, small cap, and small caps can react differently than big tech. A key thing for beginners to remember is that you're not trading the actual index itself, you're trading products that track it. Number 2, stocks. Stocks are much simpler. It's basically having ownership in a company, whether it's a small piece or a large portion. For an example, if you buy an Apple stock, you own a piece of Apple. When people say stocks, they're not all talking about the same things. Stocks get grouped into categories because different types of companies move differently. Now remember, stocks is one of the main big buckets we talked about earlier, but inside this main bucket, there's subcategories. So let's go over some of them right now. Number 1, a large cap stock. A large cap just means a large company. These are the big dogs. Think Apple, Microsoft, Amazon, Google. They usually are more stable and they move slower than smaller stocks, and they already dominate their industries. Think of a large cap like a large cruise ship. They take a lot to turn, but they're not flipping over easily. Next is a mid-cap stock. A mid-cap stocks are the in-between companies. They're not startups, but they're not mega giants either. They're still growing, and they can move faster than larger caps, which means larger companies, and they have more risks and more upside. Mid caps are like speedboats, faster than cruise ships, but still somewhat controllable. Then we have small caps, which means smaller companies. They move very fast and can explode up or collapse down. They're more sensitive to news and rumors. Think of small cap stocks like the roller coaster of the stock market. It's higher risk, higher reward, and also higher stress. Lastly, number 4, growth versus value stocks. Now, this is technically not a category, but it's important to understand because stocks also get categorized by how investors value them. Number 1, growth stocks. Growth stocks are companies people believe will be much bigger in the future. They reinvest profits, focus on expansion, and are priced on future potential. That means they can be very volatile. They react strongly to interest rates, and they dominate indexes like the NASDAQ. Growth stocks are basically the market saying, I believe in you, don't mess this up. Then we have Value stocks. Value stocks are companies that look cheap compared to what they already earn. They often pay dividends, they are more established, and they don't rely as much on hype. They tend to move slower, hold up better during uncertainty, and they're less dramatic than growth stocks. Think of value stocks like the adults in the room. Then we have number 5, sectors. Sectors matter more than people realize because stocks are also grouped by what businesses they're in. These are called sectors. Some major sectors are tech, think Apple, Microsoft, etc. Then finances, think banks, lenders, credit companies. Then energies, think oil, gas, utilities. Then there's healthcare, think pharmaceuticals, hospitals, etc. Then there's consumers, think retail, food, brands. Then there's industrial, think manufacturing, infrastructure. So why does this matter? Because sectors rotate. When tech is hot, money flows into tech. When tech cools off, money flows somewhere else. That's why when the market can be red overall, but one sector is green and another is getting crushed. This is not random. It's money rotating. So when people say stocks are moving, the real question is which stocks? Large or small, growth or value, tech or energy, etc. Because not all stocks move in the same way or even on the same day. So we covered stocks. Now the next large main bucket is number 3, futures. A future contract is an agreement to buy or sell something at a set price. But for some retail traders, a retail trader is just a regular person like me and you trading. For us, we're not trading delivery, we're trading price movement. We are not going to receive any barrels of oil or any cows. We're not receiving anything. Our only reward is profit or loss and possibly emotional damage if you're trading recklessly. Common index futures are the ES, which stands for the S&P 500 futures, the NQ, which stands for NASDAQ futures, the YM, which stands for the Dow Jones futures, the RTY, which stands for the Russell 2000 futures, and then there are subcategories. And there's 2 subcategories, micro contracts versus E-mini contracts. E-mini contracts are bigger. Think the original. Micro contracts are smaller and more beginner friendly. Micro contracts are basically the smaller version of the original. For an example, a micro is usually 1/10 of the E-mini or the original. Futures are popular for traders because it's very liquid, which means it's easy to get in and out. Think of playing a game. When there's a lot of people playing, this means you don't have to wait so long to play the position that you want to play. There's more weight when there's more people, which means levels get to your point quicker. Versus if there's less people, it might be a slow drag until you get to the position that you want to get to. Leverage also makes futures appealing. Leverage is powerful, but it can be dangerous. Another thing is trading is also 24/5, which means it's mostly always open. And then lastly, what makes futures appealing is because it has very clean price action and beautiful market structure. Okay, so the next large bucket is number 4, commodities. Commodities are real physical things. The main commodities are metals, think gold, silver, energy, think oil, natural gas, agriculture, think corn, wheat, coffee, etc. It's weather plus supply chain. The reason commodities moves is because of supply and demand, inflation, war, and geopolitical issues, whether good or bad. Also weather, global growth, and global growth just means are people buying things or not. Gold often acts like this. Someone might say, people are scared. Let me buy something solid. And with oil, the thought pattern is the world running hot or slowing down? The next main bucket is number 5, bonds. Bonds are basically IOUs. When you buy a bond, you're lending money. In return, you're getting paid interest. These are the bonds that everyone watches. This is the U.S. Treasury, government debt, 10-year note. This is a big deal. And then there's a 2-year bond, and this is also huge for rate expectations. When you buy a bond, you're lending money. And the yield is the return you earn for doing that. A yield is just the interest you get paid for lending money. So when we say bonds yield influence everything, what we mean is this. Yields tell us how expensive it is to borrow money. When yields go up, lenders are more interested, loans cost more, mortgages get expensive, and spending slows down. When yields go down, borrowing is cheaper, money flows easier, and spending and investing usually increases. Bond prices and yield prices move opposite. So if bonds are in demand, prices go up and yields fall. If bonds are sold, prices drop and yields rise. That's why bonds matter, even if you never trade them. They quietly set the price of money for the entire economy. Again, a yield is just the interest rate on money. Okay, the next big bucket is currencies, like Forex. Forex is just money versus money. For an example, euro versus the US dollar versus the Japanese yen, British pound versus the US dollar. You're basically trading which economy is stronger right now. Forex is super liquid, it's global, and it trades 24/7. The big driver is interest rates. Higher interest rates can increase or strengthen a currency because money flows there for yields. So why do higher interest rates strengthen a currency? Well, because money chases returns. When a country raises interest rates, investors earn more interest for holding that currency. So global money flows there to get paid. More demand for that currency pushes its value up. This is what people mean when they say money flows there for yield, which just means money flows there for return. For an example, let's say the US raises interest rates while Europe doesn't. Investors can earn more interest holding US dollar, so money flows into the US dollar and the dollar becomes stronger. So the last main bucket is crypto. Crypto is just digital assets. Think Bitcoin, Ethereum, etc. Crypto trends move because of liquidity, how much money is flowing into risk, hype cycles, news, risk sentiment. When people feel fearless and greedy, crypto can fly. But when fear hits the market, crypto can plummet and fall off a cliff. Now I will explain how all these 7 large buckets connect to each other. Beginners need to understand that everything is connected. So let's do a simple chain reaction. Step 1, interest rates rise and bonds yields move. If yields rise, that means money is more expensive. Step 2, when there's higher yields, then the dollar is strengthened because global money is thinking they're going to get higher returns. Then step 3, when the dollar is stronger, then that can pressure commodities because many commodities are priced in US dollar. And if the dollar is stronger, it can mean commodities are more expensive globally, which may cause demand to drop, which means prices can fall. Okay, so step 4. Higher yields also can pressure stocks, especially tech, like big NASDAQ names. These growth stocks are priced on future earnings. So when rates are high, the potential money that they can earn in the future is worth less today. So big tech can get hit really hard. So the NASDAQ can often react more dramatically than the ES. And the ES just stands for the S&P 500 futures contract. Then step 5, indexes affect futures. Indexes are the scoreboard, and futures are the tradable version. So if stocks are moving, indexes move, and future moves. For a simpler version, think of it like this. Bonds/yields affects the dollar, which affects commodities, which affects stocks, which affects indexes, which affects futures. So it's not always in a straight line like this, but this is the basic ecosystem. To recap, let's give a couple scenario for examples. Scenario 1, inflation spikes. Yields rise, markets expect higher interest, the dollar strengthens, stocks can drop, especially the NASDAQ. Gold may rise because people are afraid and they want something solid, or it may drop if the dollar is too strong, depending on the moment. Scenario 2, recession fear. Money goes into bonds, safe. Bond prices rise, which causes yield prices to fall. Dollar can go either way. Stocks may drop and gold may rise as safety. Scenario number 3, global growth picks up. Oil can rise because of demand. Small caps can outperform as well sometimes. And then a risk-on mood can boost crypto. Remember, you don't need to master everything, and you don't need to know everything at once. You don't also need to trade everything. You just need to understand what you're looking at, and you also need to know which bucket it's in, as well as trading what fits your personality. Now, when someone says the ES is moving because yields popped and the dollar strengthened, you'll know exactly what they're saying. Thank you for watching, and stay tuned for more simplified trading content.